With me at the moment is Len. Fantastic year for investors in the equity markets and investors in ETFs. Len, what's your sort of take on what happened last year?
Yeah, absolutely. I mean, I think investors can only be very happy if they had a good, strong exposure to equities. In fact, all asset classes performed well last year, so it wasn't specifically equities. But we're looking at 25% in the top 40 and 27% in our Swiss 40 fund. We were very chuffed with those results, although we can't claim too much responsibility. We are passive managers, so we just buy what the market gives us. But we were able to keep our costs relatively low as well, which we were very happy with, and hopefully we can achieve going forward.
And for the benefit of viewers, there are a couple of products from different investment houses competing in the same space, and we are seeing costs go down in those areas. I mean, just from the sort of beginning, if I remember when we started about 10 years ago with the first ETF, costs were at about 45 basis points, 50 basis points. What sort of effect is the competition having on those costs now?
The competition is definitely having a downward effect on costs. Asset managers now are realizing that they can't only access the retail market for assets under management, and they are starting to penetrate the institutional market. The nice thing about ETFs for retail investors, though, is that when you do cut your fees and offer them to institutional investors, the retailer gets the product at exactly the same cost. So we've brought them down from approximately 45, as you mentioned earlier, to around about 30 basis points. We've actually managed to achieve 25 on several occasions. I'd say an average cost is around 25 to 30. But that's a great advantage for retail investors, that they can access products that are offered to institutional investors at institutional costs.
Not only that, but I mean, we've seen just the sort of mushrooming in the amount of products offered in terms of both ETFs and the exchange traded notes. What's your sort of take on how the retail investor in South Africa is adopting ETFs?
I think that there is an under-adoption of ETFs in South Africa. I think the reason for that is predominantly that South African investors don't tend to invest directly on the JSE. They like to be intermediated, they like to speak to a financial advisor, and typically financial advisors will steer investors to unit trust kind of products. That certainly is changing. The JSE has done a lot of work on accessing the retail market. So we're hoping that there will be an increase in investment into ETFs. But we're also seeing a little bit of an increase in the way, an increase in the trading. The way that retail investors trade ETFs is definitely increasing. So they're not using them as buy long-term, sit in them for 10 years and realize your profit at the end. They're actually starting to use them as trading instruments as well, which is very encouraging.
So almost taking bets on the market from time to time.
Absolutely. I mean, I think we've seen our market's gone through the whole warrants, single stock futures kind of wave. Hopefully, we think that ETFs are probably a little bit more of a safe product, very easy to understand, and we're hoping that we'll see that kind of liquidity come from the retail market going forward.
I personally always get a little bit hesitant when I hear investors wanting to trade things, and I know when we look overseas, there's things like leveraged ETFs. How far away do you think we are in South Africa before we see a product like the leveraged ETF? Any guesses there?
I think we're quite far. There is a lot of legislation being looked at the moment that will allow hedge funds to be regulated by the Financial Services Board, and that will allow some gearing. But I don't know that we're going to have highly geared products available to retail investors anytime soon. Certainly our regulations at the moment don't allow for it, so it's not even a question of whether there's appetite or not. We just simply can't do them right now.
Now, just going back to my earlier question around the perception of ETFs by investors in the local market, do you think there's a greater awareness, though, between the retail investor and the financial planner around the use of ETFs, or do you think it's still a lot of work needs to be done there by the industry collectively to make people aware of the benefits of ETFs?
I think there is a lot of awareness around ETFs in the sophisticated trading market or the sophisticated investing market, the high net worth private client market. I think we've got a lot of work to do in terms of penetrating the market that has traditionally been serviced by unit trusts. Unit trusts are, obviously there's trillions of rands under management there. ETFs aren't even close to that. So there's still a lot of work for us to be done. And not only in the education, but in making these kind of products available through platforms other than the JSE. We can't rely on people to go and get their own stockbroker and go through all of the requirements to get those. We need to make these things more accessible through alternative distribution channels.
And I think when you talk about that, we talk about passive strategies in two different vehicles, and obviously ETFs directly in shares is one form of that, but obviously ETFs in the unit trust format is is another form. Do you think that's quite an important feature going forward, is making the passive strategies available in the unit trust as well?
Absolutely, and Stanlib does in fact offer passive unit trusts. For various reasons, they are slightly more expensive than the ETFs. But generally speaking, for a retail investor, if he wants to buy a passive investment, it's kind of indifferent as whether he goes through a unit trust or an ETF from a cost perspective. If he's buying the ETF through a platform. If he's buying in size through a stockbroker, it's much cheaper to go through the stockbroker.
And do you think that it'll be cheaper to do it through the unit trust format than ETFs if you aren't using an investment plan?
I think it's very comparable. I don't think there's an advantage from a cost perspective one way or the other.
Okay, so it's pretty much indifferent from a cost perspective there for a retail investor to access those strategies.
Yeah, if you're a small investor, well, I say small investor, but 500 Rand a month or 1,000 Rand a month, you're not really going to realize a massive advantage from exchange traded funds. I mean, I think that has been missold if that is the message that's been put out there. But certainly we do believe in passive management and the use of passive instruments, and we offer segregated portfolios to our bigger clients. We offer unit trusts to the retail investors, and we offer ETFs to everyone in between.
Right, just turning our attention to the composition. You run the Stanlib 40 and the Stanlib Swix index, and I wanted to make sure I got that right, because
Yes.
on air I got it wrong the last time.
Right.
I wanted to just talk about the composition and what you said off air about some really big changes in those ETFs. So I think just for the benefit of viewers, we talk about these portfolios rebalancing according to size every quarter. Just tell us what's going to happen this coming quarter in March when those portfolios rebalance, especially with regards to the Swix index.
So I think it's important first to differentiate between the top 40 and the Swix index. Both of those indices hold exactly the same shares. So they hold the top 40 shares that are listed on the JSE. The difference between the top 40 and the Swix is that the top 40 looks at the total market cap of each of those companies when it's ranking the shares in terms of what size to invest in that particular share. The Swix index at the moment looks at South African investors invested in those shares. So it's a much smaller universe, and it tends to downweight things like the dual listed stocks, the Anglo-Americans of the world, the Investex, the old mutuals, where there are a sizable portion of the investors are actually on foreign markets and not on the JSE.
So the dual listed stocks, effectively the stocks listed in Joburg and places like London.
Correct, absolutely. And it has to be a primary listing. Things like depository receipts and that don't count for these purposes. Okay. What the JSE are doing now is that they've said the shares that are owned by foreigners on the local exchange are available to asset managers to trade. So they should be included in the Swix index. So they are they're tinkering with the way that they structure the Swix, and it's going to have quite a big impact on our next rebalancing trade, which is coming up in March.
So just to get this right, you've got a lot of retailers in South Africa that don't have dual listings overseas. So their entire market cap or their free float is based on the JSE. A lot of those have foreign shareholders, which for the purposes of the Swix were excluded previously. And now, because we're going to look at it from an exchange point of view, where those foreign shareholders are based, they will now be included, their shareholding will be included in the free float.
Correct. So if a foreign investor has bought a share on the JSE, that will be included in the free float going forward.
So some of those retailers in the top 40, for instance, and I'm just using the retailers for example, I'm sure there's others there, they will see that their proportionate share in the Swix index will go up.
Correct, absolutely. And that's, we were looking at some numbers this morning. We generally churn around about 15% of our portfolio on an annual basis. This one rebalancing is going to be 17% of our portfolio. So it really is a massive event. I don't think anyone can predict with any certainty what that closeout or what that rebalancing day is going to look like on the JSE. I would think it's going to be quite messy. A lot of volatility. It's going to be an interesting day. We're looking at ways of perhaps staggering our trades, but we haven't, a little bit before the rebalancing date and a little bit after, but obviously we've got to be conscientious of taking too much tracking error risk when we do that.
Okay. Just talking about the actual composition of the top 40 index, I mean, how has that changed over the last few years? I mean, you've been involved with exchange traded funds for some time now. When I first looked at the composition of the top 40 index 4 years ago, resources were, I think, about 43 to 45% of the entire weighting of that index. What does it look like now, and how's it changed?
It hasn't really changed, to be honest. Our economy, or our market, our financial market, is still very dominated by the resource stocks. There are small changes, as the prices, for example, over the last 6 months, obviously retailers have picked up in terms of their weighting in the index. But I would say, generally speaking, it's been a very stable, static index, which is what it's supposed to be. It's not supposed to be very dynamic and very volatile.
Right. Something we've talked about off air before, and what was quite interesting to hear about how institutional investors and active fund managers, we have this constant debate between active versus passive. But you've made some interesting points around how active managers are using passive products at certain times in their portfolio. Can you just give our viewers an example, a couple of examples on how those are done?
Yeah, sure. I think Stanlib's basis is that the active versus passive debate is kind of dead. Each type of product has its advantages in certain market conditions, and the challenge for us has been to go out and chat to active managers. But as you just stated, active managers are now using ETFs a lot more actively, and the way they're doing that is a lot of the research says that your asset allocation decision is very important, rather than trying to outperform a particular asset class. Rather, just buy that asset class, and provided you buy the right asset class, you're going to perform well. So we've seen a lot of managers come to us and they say, give us an ETF in each of the asset classes, and we will decide on which asset classes to over and underweight. So that's the first one. The second one is that if you're sitting on R1 billion or R2 billion, it's very difficult to outperform the index using that, actively trading that entire amount. So what a lot of managers are doing now is they're indexing a large portion of it, say 70% of it, and they're only actively trading the other 30% to try and achieve their alpha.
So, this is something we look at when I look at funds run by active managers. A lot of the time, there's just so many stocks in there. You kind of just think that they're getting their core, their beta return, by actually just going and buying the index themselves in an indirect kind of way, and then really going for the alpha with a couple of calls around the fringes, which are sizable, but as a number of stocks in their portfolio, it's quite small.
Yeah, and there's two reasons for that. It's very easy to vilify active managers, but the fact of the matter is that structurally our market is set up that it's very difficult to do anything other than track the index. And the reasons for those are the liquidity of the underlying stocks. We've only got liquidity in perhaps half the stocks that are traded on the JSE. The other reason for that is that the managers are benchmarked against the SWIX index, and they're penalized if their performance differs from the index too much. So it means that they have to closely map what the index is doing and then outperform whenever they can. So I have sympathy for active managers who are in long only positions, who aren't allowed to gear, and who have to are benchmarked against SWIX index.